Okay, again, we're doing problem 5-9, and we're going to do the adjusting entries first. Last time we talked about the 4 kind of adjusting entries, which, we went over those prepaids and, accruals. And so we're not going to really worry too much about, what the names of them are right now, but we're just going to do these adjusting entries. Okay, so number 1 has to do with depreciation. And in depreciation, we bought this asset, and then we're going to depreciate it over time. And that fell into, do y'all remember what kind of adjusting entry that was? It kind of fell into a weird one because it didn't really fit in with that one. It was the prepaids, because we have this asset that we have, we put it in the asset account, and then we gradually expense it. Okay, so what was the asset that we bought? It was the building. And then we're going to depreciate it using, okay, now you guys can help me out here. How do we depreciate, y'all might have gotten scared off by these numbers, right? Just think about what is the journal entry for depreciation expense? Don't know? Where do we find that? No. What I mean is in the book, where do we find it? Where's that stuff we were looking at, those 4 kinds of adjusting entries? It's in a little box. I think it might be on page 97. See if that's right. Is that right? Okay. All right. So then keep flipping, see if you see anything about depreciation right after that. What page is that? 101. Okay. See that entry for depreciation expense? Okay, so what's the entry for depreciation expense? What do we debit and what do we credit?
We credit accumulated depreciation.
Okay. Credit accumulated depreciation and debit depreciation expense. Okay, so we're expensing something. See, that's our whole job here, is we had this asset and now we're going to expense it over time. And why are we debiting the expense account? We're increasing our expense account and we're decreasing our asset. How are we decreasing our asset? With accumulated depreciation. That's a contra asset. That's going to decrease our, in this case, it's a building. Okay, so accumulated depreciation building. Okay, we're still going to stick with you guys. The buildings have an estimated life of 30 years, and there's no salvage value, and we use the straight line method. So can you guys come up with the amount of depreciation expense for me? What's our building? 120,000. So how do you calculate depreciation under the straight line method? Sticking with you guys. How do we calculate depreciation expense?
Multiply by 30.
Okay, we're getting close. Would we multiply it by 30? Maybe we'd divide it by 30. So what happens if we divide 120,000 divided by 30? We get 4,000? 4,000. 4,000. Okay, so every year we're going to take $4,000 worth of depreciation for 30 years. If we do 4,000 for 30 years, that's going to fully depreciate our asset, right? Now, so straight line method, all you do for straight line method is take your cost and divide it by the number of years. But if you have a salvage value, you subtract the salvage value. So what's a salvage value? That's going to be what's left, what you estimate is left over at the end of their life. So if they said the salvage value was $10,000, you'd say 130,000 minus 10,000 divided by 30. 120,000 minus 10,000 divided by 30, right? Okay, so now what's our journal entry for the depreciation for this? It's debit depreciation expense for 4,000 and credit accumulated depreciation for 4,000, right? Okay, so now we're going to go to number 2. Sorry, I think I'm still stuck on you guys, right? Okay, so number 2, the equipment is depreciated at 10% a year. So tell me, what is my journal entry for this? No numbers, just what do I debit and credit?
Credit equipment. No, debit equipment. Debit.
No, we're sticking with these two. Yeah. So similar to what we did here, what's our journal entry for depreciation expense every time? What do we always debit? Depreciation expense. Okay, and we're always going to credit accumulated depreciation. This is the thing every time. But in this case, we just have equipment tacked onto the end, okay? So now we want to know, what is our amount? So equipment, how much do we have in equipment? 150,000. It depreciates at 10% a year. What does that mean? 10%. What do we do with that? Okay, so we get 15,000, right? Okay, there we go, 15,000. That's our journal entry. That one was painful, wasn't it? Okay, I knew that was going to be the hardest one. All right, so now we're going to go to, any questions about depreciation? Okay, now we go, later on you're going to find like accelerated methods. There's going to be all these other kinds of depreciation. You're going to have to know how to calculate depreciation about 4 different kind of ways. But right now they usually just tell you straight line or this percentage thing, okay? It'll be later on that you get more complicated. All right, number 3, insurance expired during the year of 3,500. Now, how much did we have in insurance? You guys, this was you guys in the back, right? Yeah. Okay, so.
What was the question?
Well, let's see, what are they talking about? Insurance expired during the year. Prepaid insurance. So how much was in prepaid insurance? 9,000. And they say so much expired. What does that mean?
That means that a certain amount of their prepaid insurance expired during that year.
So it was used up, like, right? It was used up. So in other words, they gave us the answer. I mean, they gave us the answer of how much, right? 3,500 is our amount that we're going to make the entry for. Am I right on that? Okay. Now, if they had given us the ending balance in prepaid, then we'd have to subtract that to calculate it, right? But they gave us the answer. Now, all you guys have to come up with is the debits and credits.
Debit insurance expense?
Okay, so we're increasing the expense, and we're going to credit the prepaid. Okay, so the next one, you guys are handling the next one. Rent revenue represents the amount received for 11 months for dining facilities. The December rent has not been received. So, y'all want to explain that one to me?
All that I did was I saw our rent revenue at 17,600, and I divided that by 12 and got 1,466. So that's each month, how much their rent revenue was each month, and they received only 11 months, so I minus 1 month, which was 1,466.
Okay. How do y'all feel about his police work there?
I think you should divide it by 11. Then it's about like 12.
We have 11 months in there, right?
Well, okay. So.
Okay, so let's think about that. They put some amount in there for 11 months, right?
So you don't even worry about that month that they didn't get paid for?
Well, they didn't get paid for that 1 month, but they should have been paid for another month. So what are they saying here? We don't have enough months in here. We need to accrue for the fact that they still owe us for 1 month, right? Okay, Yeah, sometimes it's kind of hard to figure out what they're saying to us. I mean, it's like this little puzzle that we've got going here. But it's kind of typical that a lot of times your revenue accounts only have 11 months in them because you haven't accrued the amount for the 12th month. And so what you have to do is accrue the 12th month amount. Okay, so you're on the right track, of what we need to do, but you just kind of got mixed up in the, math of it. Okay, so let's think. We had 11 months in there, and we need to add another month. So we need to figure out, and you were doing exactly the right thing, figuring out how much it is a month. So how much is it a month? $1,600 a month. Did you get that? That number divided by 11 is $1,600. So now we know the 12th month should be $1,600. Okay, now you help me out with the journal entry. What should the journal entry be? Do you think, were you on the right track with the journal entry? We want to record the 12th month of rent.
So I didn't get that far.
Okay.
But would you?
We want another month of rent. What are we going to do with the rent part of it to get another month in there? Okay, yeah, we got it. So we could call that rent receivable, or we could call it accounts receivable. Let's see, what do they eventually call this? Rent receivable. Okay, so we're going to call it rent receivable. Usually the accounts receivable just typically are your regular customer accounts, and any unusual receivables, you name them something else. All right, so we're going to call it a rent receivable, and then what are we going to credit when we want to put another month's of revenue in there? Revenue, there we go, rent revenue. Okay, so now let's go to the middle guys, right? So number 5, it's estimated that 12% of the accounts receivable would be uncollectible. You want to just give me the accounts for this? What are we going to debit? Accounts receivable, and then credit what? Allowance for doubtful accounts. All right, so how do we feel about that police work?
I'm not sure.
They're not sure about your police work.
If you add to accounts receivable, what you're taking.
So what y'all are doing is adding to accounts receivable. Is that what you meant to do? Okay, so think about, okay, now what do you have? Got another idea? What are 4 types of journal entries? What are our 4 types of journal entries? Go back there. Look at that kind of, what thing are we dealing with here? See if you can find the thing for bad debt expense or allowance for doubtful accounts. What page is it? 108. Okay, page 108. There. Okay, yeah, bad debt expense. Sorry, I kind of gave you the answer there when I said bad debt expense, right? So now what are we doing? Like on your journal entry, what do we do? What are we going to debit and credit?
Debit bad debt expense.
Okay.
Credit allowance for doubtful accounts.
Right. See, we're expensing something. Okay, let's think about that bad debt expense entry again. Remember we did that last time. Why are we expensing this? We are matching the expense of these deadbeats that aren't going to pay us with the revenue that we got when we sold something to them, right? This is the matching principle, or what I think they call it something else. Yeah, matching principle, yeah. So we recognize the revenue when we sold them something, but they're, what?
Is it revenue recognition principle?
No. Yeah, no. So, and then we're going to and then we're going to record this expense that goes along expense recognition. Yeah, they used to call it the matching principle. Now, expense recognition principle. Okay, so remember anything that's directly associated with revenue, we match it with the revenue. Any expenses that are associated with revenue, like cost of goods sold, okay? And like this bad debt expense. We're directly matching it in the same period as the revenue. Okay, so we're increasing this expense and then allowance for doubtful accounts. Now, we've got that far, but what is the dollar amount?
1560.
Okay, so 15, how'd we get that? 12%? 12% of the accounts receivable? $1,560. Huh. So our Oh, I see the problem. They think of all of the accounts receivable, 1560 is going to be uncollectible, right? So what does that mean? 1560 is that's our ending balance in the allowance for doubtful accounts. Okay, so look at your little sheet here. What's our current balance in the allowance for doubtful accounts? 1,100. We want our balance to be 1,560. So now what do? Credit it for 400. Yep.
Would you not change the accounts receivable by 1,600 before you did that?
No, the accounts receivable just stays like it is. The accounts receivable is $13,000. That's what everybody owes us. Now we estimate that 1,560 of that's not going to be collectible. So that's going to offset on the balance sheet. It's going to be 13,000 minus 1,560 to be our net amount of what we think people are going to really pay us.
So when they started at the beginning of the year,
They had estimated some other time. Yeah.
some of it is already going to be uncollectible.
Right.
You don't have to move that.
Right. And they might have had some people pay out of that, and that account might have gone up and down from the beginning of the year. But the balance right this second is 1,100. Yeah. So at the end of every year, you're either going to adjust your account to this allowance amount, or you're going to come up with a bad debt percentage and charge a percentage. There's two different ways to do it. I think the last problem that we did was the percentage method, where we took a certain percent and we expensed that much. In this method, we're adjusting it to an amount, okay? Well, remember I told you there was going to be more detail on this in later chapters, but there's two methods of doing this. So be careful. Here's one that we're doing it where we adjust to the amount, okay? Yeah.
Why did we just do 400?
Because it already had, 460, yeah, you're right. 460. Yeah, good catch. Okay. All right, so now number 6, we're sticking with you guys. Salaries and wages earned but not paid. So just give me the debits and credits of that. You guys want to help him? What you got for that entry?
You want
Just the accounts.
salaries expense, debit, and credit salaries payable?
Yeah. Okay. So what are we doing here? We're accruing our payable, for what we owe people. We're increasing our payable, and we're increasing our salaries expense for what they owe these guys as of right now. Yeah.
Even like before we've seen this, we didn't see the salaries payable, so we can just open an account.
We just open an account called salaries payable. They don't have it on the books.
But you can always just open an
Just open an account just like they need, and a lot of times they don't have stuff on the books that you need. You have to create it, yeah. So how much is our amount there?
3,600.
Right, okay, so 3,600. All right, so now let's go to number 7. Number 7, dues received in advance from members, 8,900. You doing that one? Okay, excellent.
I would say cash and, accounts receivable, or what would
So we received, okay, we received these dues in advance, and you're right. If we were doing this original journal entry where we were receiving the cash and that sort of thing, but in the adjusting entries, let me just give you a clue. They've already recorded all the cash transactions. All the cash is exactly right, okay? This is an important principle. Cash is not adjusted in the adjusting entries. Remember, in those 4 boxes, out of all those entries we did, not one of them had anything to do with cash, right? So that's how adjusting entries are going to be. So now let's think about this. When they've already received the cash and they did something with it. Okay, let's put it this way. Myrtle did something with it, right? Okay, when she got the cash, she should have said, just like you said, cash, was it 8,900? Yeah, cash 8,900. She should have debited cash and credited what? You had it right. Unearned revenue, right? So she should have done this, unearned revenue, 8,900. Is that what she did? Look and see. Is there an unearned revenue there? No. It'd be there where? In the liabilities, right? There's no unearned revenue. So she did not do that, right? Myrtle. Myrtle's our bookkeeper, right? So what did she do instead? What did she credit instead of unearned revenue? What does Myrtle always do when she gets cash? Yeah, revenue. She puts it in revenue because that's what she's used to doing. She's not sitting there wondering whether it's earned or unearned. She's just putting it in revenue, okay? Now, this is a standard thing that Myrtle does, okay? So this is another standard entry that you're going to have to make. Accrue your revenue and accrue your unearned revenue, okay? So now what are we going to have to do to fix Myrtle's mess up? Instead, what she did cash and revenue. Right, so we want to get what she did out of revenue, right? So we're going to debit revenue and credit where we wanted it to be originally was unearned revenue. So that's 8,900. Okay? All right, so does that make sense? All right, we're getting really taken. Yeah, we're doing okay, I think. Maybe. Yeah, we're doing okay. All right, so now what we want to do is post all of those things to our trial balance. Have y'all been doing this along? Putting our, what do I mean by that? We take depreciation expense, add a depreciation expense down here, and post it down here in the debit and credit columns, to make them add up. So I don't think I'm going to do all that on the board because, do you see what I mean? The first one's depreciation expense. So we're going to go over here to this column in the debit column and in the credit column, and under depreciation expense, we're going to put 4,000. And then we're going to find the accumulated depreciation building and put 4,000 in the credit over there. Do you see what I mean? Just one by one down the line. And a lot of times what you do is you put a little, since that's the first journal entry, I like to do like this. Put a 1 here and a 1 here. Then later on, if you need to match these up, you can match them all up.
Is
Yeah.
that what you're saying for if we have to use depreciation expense more than once?
Yeah, in case you do have to use it more than once. Yeah. then you can have those two entries there, and then you can match everything up later on, because a lot of times you do have to make more than one entry to an account. All right, we're going to take just a second and let y'all, yep.
Real quick, for 2,
Uh-huh.
we got 15,000 by multiplying 150,000 divided by point.
No, times 0.10.
I mean, yeah, times.
Yeah, or divide it by 10, either one. Yeah,
Okay.
yeah. Yeah, times 0.1, really. So yeah, if y'all have any questions on these as you're going through them, how did we get all of this? So by going through this, I'm seeing that maybe y'all need a little more practice with adjusting journal entries, right? Because this is like a key thing in the chapter. And on the, we're doing a quiz Monday, and you're going to be like on your own in a group, or not on your own, in a group doing this. And so you'll need to be really familiar with how to do it. You might have missed that Monday we're having a quiz. We're going to be in a group of 3, and you can come up with your group of 3. So there'll be 3 groups of 3, and just Monday I'm going to want to know who's in your group, okay? Is somebody missing today? Yeah, somebody's missing today. Okay. All right. Okay, so how are we coming with doing that? And then you're going to add them, you're going to add them across to have an adjusted, you're going to have over here your adjusted trial balance. Okay, so now what I'm going to do, instead of posting all that, I'm just going to put the adjusted trial balance right here. Okay, y'all keep going because you need to know how to do this, but I'm just going to fix my adjusted trial balance. Okay, so when you do, notice that on your trial balance, you have a total at the bottom of $815,000. So the debits in the trial balance are $815,000, and the credits in the trial balance are $815,000. So what does that tell you? it balances, right? Okay, so now on your adjusting entries, the debits, should your debits in the adjusting entries equal your credits in the adjusting entries? Yeah. So, I mean, the question is, do they? And it would help you find an error if your if your debits don't equal your credits, then you'd know you made a mistake. So let me just give you the amount there. It's $37,060. That's the total of your debits and credits, okay? So you can kind of see if you made a mistake by doing that. And then when you get to the adjusted trial balance, your debits there should also equal your credits. So before you do financial statements, you want to make sure that the total of your adjusting entries equal each other and the total of your debits and credits in the adjusted trial balance equal each other. And so I'm hoping that my debits and credits equal here. The total is $839,660, okay? So I'm just going to look at them one more time and make sure that it looks like they are what I have written down here. Okay, so I did this problem before we came to class and typed it on the worksheet and stuff. So they didn't, I don't think, did they ask us to do, I don't think in this problem they actually asked us to do a income statement and stuff. But I went ahead and did the income statement because I liked this problem because it had like detailed entries. So I thought, well, this one is a good one to do, okay? So I went ahead and did an income statement and stuff. And now that's our next step. Are y'all kind of okay with the adjusted trial balance? Have you gotten that? No? Maybe if you want to just put these numbers over in the right column and you can figure out where you went wrong later. Or alternately, don't worry about that and let's just do the financial statements from what's on the board. Because when you walk out of here, I'm going to give you a corrected thing, okay? So you're going to have a solution that I'll either post or give it to you. Yes?
Real quick, just when you are doing the adjusted trial balance,
Right.
when you're looking at the trial balance, the original trial balance,
Right.
I mean, does it matter if you look at the debit or the credit to adjust that trial balance?
Okay, yeah. Okay, so like for cash, you had a debit of $15,000 and then there were no adjustments. So you just bring that over to the debit of $15,000, right?
So you just bring that all the way over to the
Right. You're going to take your $15,000 plus these debits minus these credits and get a debit here, right? Okay, so let's take another one that had an entry to it. So let's look at allowance for doubtful accounts. Allowance for doubtful accounts had a credit of $1,100. See that? Then what did we do? Our adjusting entry was a credit of $460. So that gave us what? A credit balance. We're adding our credits together to get $1,560, right? Okay. Yeah, okay, good. I'm glad you asked that because I don't know where you're going wrong if you don't ask. So like rent receivable had zero balance. See how I put the rent receivable right here, up here where it belongs? It's helpful to have it up there. Where does it belong? With the assets, right? So I put rent receivable up there. We started out with a zero there.
On that one, so go ahead and make your own rent receivable.
Make your own rent receivable.
Receivable.
Yes.
Okay.
Yes. Usually accounts receivable is just your generic receivables, but this is a different kind of receivable, rent receivable. So we had nothing. We add $1,600 to it, so we have a debit of $1,600. Yes.
What was the balance for the adjusted trial balance?
Oh, the adjusted trial balance was $839,660. Yeah. All right, so any others that seem confusing the way they worked? Do y'all want to work on this a second to get it right? I think we have time if you want to. What do you think? Sounds like y'all, I mean, it looks like y'all are still working on it. So tell me, what do we have questions about? Anything?
I was just making sure all my.
Do they add up?
Yes, ma'am.
Excellent. How about yours? Do they add up?
I haven't done it all yet.
Okay.
I'm still,
Are you processing all of this? Yeah. Okay. Now remember that what I filmed is out there for you to look at. You know, we did a video. So there's a video out there for you to look at. It's
Okay.
what we did Monday.
Monday, okay.
Yeah. Okay. Because that, I mean, these adjusting entries, they're, you know, they're an important part of the chapter. Yeah.
The only thing I'm
Yeah.
saying, I understand it all except for anytime it's a trial balance debit and you have a credit, you minus. And
Yes.
anytime you have a debit and a debit, you add.
You add
Anytime
it.
you have a credit,
That's right.
Credit, you add.
That's right.
Okay, that's
Yeah.
all I was confused.
Yeah, that's right. So any other questions?
You had something you said about always, debit depreciation.
Yeah, on our adjusting entries, depreciation adjustment, we're recording depreciation expense. So we're going to be debiting depreciation expense because we're increasing an expense with a debit. Expenses always have a debit balance, so we're going to always increase them with a debit. And then on this particular, most of these entries, they kind of are similar. You know, if you're going to record depreciation, you're going to debit depreciation expense, credit accumulated depreciation. That's how you record depreciation. Yep. Okay, so I'm going to erase all of this stuff, the adjusting entries. Is that okay? All right. So now we're going to do financial statements from this. And remember, the one that we're going to start with is the income statement. Yep, we're going to start with the income statement. All right, so the title to our income statement and to every statement has 3 lines. Did I give y'all any of those? Yeah, I gave y'all 2 lines. What goes up there at the top? The name of the business goes on the top. Then the next line is the name of the statement. So in this case, what's the name of our business? Crystalwood or something? Crestwood, okay. All right, so Crestwood, whatever that is. And then the income statement will be on the next line. And then on the next line is the date, right? Okay, so how can you mess up the date? How can you mess up the date on these? Seemingly, I've given you the answer to this. On the balance sheet, the date is the date, right? Because the balance sheet is a point in time. So it's as of December 31st. That's the thing. But on the income statement and the statement of owner's equity, do you see the difference? It says year ended this because it's for the entire year, okay? All right, so this is for the year ended December 31st, whatever it is, right? So 3 lines. Now, when y'all do this in your groups, and you're going to do this quiz, I'm going to be looking at these kind of factors, right? So you want to know these things. Okay. All right, so what do we do with the income statement? Where can we find our income statement accounts? Right, and which ones are they? Okay, so they start down here with revenues and expenses. And that's why it's really nice if you did these in order, you know, that they're just going to all be down here. If whenever you add an account, you put that was a balance sheet account, if you put it up here, it'll make it much easier on yourself. So the revenues and expenses usually come at the end. And what's our formula for the income statement? What do we start out with? How do we get net income? Revenues minus expenses. Revenues minus expenses equals net income, okay? So this one is normally a pretty easy account. So, or a pretty easy financial statement, because all we do is we start with revenues, and then we list the revenues. We have dues revenue, what is that? G revenue, and rent revenue. We have three kinds of revenues. Greens revenue, and the amounts of those, okay, we can put that in the, it doesn't matter particularly, but most people would start out in the right-hand column, 191, 100, 5,900, and 19,200. Okay, so these are our total revenues, okay? Total revenue is 216,200.
So we wouldn't put that in the middle of the 3 1.
I mean, you could, and then you would put the total over here. These three numbers could be in the middle and then the total over here, but this is kind of picky right here. Some people start out with the first numbers on the right side, but the expenses we're going to put in the middle. So it's up to you about that. The revenues could either be here or here. The expenses would always be over here. Okay. All right, so we've got our total revenue, right? Now, we put a dollar sign right there. Okay, you might just want to look in your book to see where the dollar signs go. And you can kind of look in your book to see how they did the financial statement on that sample financial statement on page 109. So on that sample financial statement, see they only had one. Okay, so we put our dollar sign on the first thing there, and then we get our total, and now we're going to have our expenses. And now we're going to list our expenses out, starting with utilities expense. And that's 54,000 in the middle column. And this would definitely be in the middle column. Since it's the first thing in the middle column, you're going to put a dollar sign on it. And then you're going to list out all your other expenses and get a total expenses of 184,560. Okay, so your total expenses are this. We have our, actually, okay, so our total, we list all this out, total it up, put it over here, and we're going to have revenues minus expenses equals net income of 31,640. Okay, so see how that works? Revenues minus expenses is 31,640, right? Yep.
On the test, would you have something like this where we fill it out?
I would likely have something exactly like this on the test.
Okay, so there's the 3 columns,
Yeah.
and on the left column, I'll put the expenses, in the middle column, I'll put the revenues. And I use the third column as the totals thing. Is that okay?
Yeah, that's okay.
I just didn't know if you would take off.
I wouldn't take off for that, but usually for the income statement, you just use 2 columns. The reason I have 3 columns there, I don't know. Usually you just have 2 columns on it. Yeah. Yeah. I think it just worked out with all those lines I had above there that somehow I thought it'd be great to have that empty column, but it's not a good idea, really. Yeah. Okay, so we're okay with this? And remember, we put a double underline under net income. And we put a dollar sign on net income. Yeah, so like I say, I'm likely to have something extremely similar to this on the test and on that quiz that y'all are doing. Okay? Monday. Extremely similar to this. Okay, so now we're going to do the statement of retained earnings. So how does the statement of retained earning or owner's equity or whatever work? We're going to start with the beginning balance. Okay, I'm not going to do the heading up here. Y'all can look and see what the heading is. But we start out with the, in this case, it is retained earnings, okay. So we're going to start out with retained earnings at January 1. We're going to start out with the beginning balance, right? Which is 82,000. So what is our formula for retained earnings? Add net income, subtract dividends, and that gives you your ending balance, okay? So all we're going to do is say plus net income or add net income or something like that, and that is 31,640, and then that gives us retained earnings at December 31, which is 113,640. Okay, so does that make sense? Oh, well, I guess we need to make it a little prettier, right? What did I leave off to make it pretty?
Dividends.
Well, we had no dividends.
So if it doesn't show any, you don't have to.
Yep, don't have to do it.
So you left something off to make it.
Yeah, my little pretty thing to make it.
Another line, 2 lines.
2 lines, yeah. And $sign, yeah. Okay, so when I say I left that off, I mean, I'm going to count off for that, okay? Really an important part of these financial statements is how they look. So you should basically memorize how those financial statements look on page 109 and 110.
So you put the double lines underneath the total.
Underneath the total.
So there you say plus net income?
It could be add net income or, yeah, in the book it says add net income. Yeah, it could be either one of those, really. Okay? Anything else on this one?
You said whenever we're making financial statements, like you said, they have to look right with
Yep.
underlines and everything. Also, whenever we're writing a quiz, we can't abbreviate. Is that right?
Yeah, on this quiz and on your thing for the test, don't abbreviate. Okay, yeah, I abbreviated all over the place. Do not do that.
So you want us to write out accounts receivable?
Accounts receivable, all written out. Revenue, all out.
Question: Can we? I don't know if we should, but put all the depreciations together. Expenses, building,
Yeah,
equipment.
yeah.
Or should we keep them separate?
We should put them together. Do I have them?
Together.
Okay, yeah. Okay. All right, yeah. Well, you do the depreciation. Oh, I'm sorry. You do the depreciation expense together, but the accumulated depreciation, it's optional whether you do that together or not. Okay, did y'all have a question back there?
Well, I just couldn't get my income statement to add up for my expenses. I think I messed up on one.
Oh, okay.
I was just looking at them.
Oh, okay. Yeah. All right, so now I'm ready to do the balance sheet. Okay, so what I'm going to do here is erase this income statement part, okay? Is that good? So now we have used, these numbers to come up with the income statement. The rest of these numbers are going to be on the balance sheet, right? And where are our assets? Yeah, down to accumulated depreciation. So all these things are assets, right? And all these things, where are our liabilities?
Payable, fire revenue,
What is this?
common stock.
Where does that go?
Or is it-
Yeah, okay, so just these things are liabilities, right? So where does this thing go? Common stock and retained earnings, that goes where? Owner's equity. Okay, so that right there's our balance sheet, right? I mean, that wasn't hard. We've already done our balance sheet, pretty much, right? All that stuff has to go in the assets. All that other stuff goes in either liabilities or owner's equity. And so let's just see how we would do that. I'm going to see what my time is. Okay, so we have 15 minutes. So what I'm going to do is let y'all do the assets part. Y'all do the assets part right now. How about that? See if you can get total assets.
Is this split up into?
Yeah, 2 columns. 2 columns. Rent revenue. How did rent revenue get up there? That is rent receivable. Rent receivable. Yep. Okay. So what they said on that 1600. Which number is that? Rent revenue represents the amount billed. Oh, number 4? Oh, rent revenue is for 11 months. December's not been recorded. Rent revenue was 17,600, and we're going to add in 1,600 to get 19,200. Rent revenue. Okay. Okay. Rent receivable is debit 1,600. Yeah, after class, yeah. All right, so I'm still waiting on somebody to give me a total assets number. Okay, just tell me what it starts with if you get it. Don't tell me the whole number. Was it start? Oh, I got you. Never mind. Okay, yeah, I just can't wait. I'm on the edge of my seat for this number. So it starts with a, okay, it starts with a 5. That's good. Anybody else have a total assets number?
Quiz, is this gonna be bigger?
You don't like the whole size of it, right? I think you might have a blank sheet of paper. How about that?
Sounds good.
Okay. Yeah. Yeah, you might have a blank sheet of paper. You have a number, right?
Yeah, I got one.
Does it start with, what does it start with?
Starts with 6,
That's not good.
for total assets.
Yeah. Maybe you didn't subtract something that you were supposed to. Did you subtract accumulated depreciation? Yeah? Two kinds of accumulated depreciation?
That's where it's at.
Yeah. Starts with a 5. So now you get to give me the second number. A 2. Excellent. Okay, now we've got 2 numbers. I like it. The third person gets to give me the third number. A 6. Yeah, we're getting there. Okay, so how's everybody else doing? Okay? Or not quite there? Not there? You want me to give you another minute? Yeah, I can't give you too much time because we only have 9. Wait, when is this? 15? Yeah, 45. Yeah, we have 9 minutes. Okay, so our total assets is 526. 526? 140, yeah. Okay, so that's our total assets, which is going to be double underlined and dollar signed. And you know, you're going to have had 2 columns there, and at the top of each column would be a dollar sign, right? No other dollar signs besides that. Dollar signs at the top of each column and then at the total. Okay, now on the right side over here, you're going to put your liabilities and your owner's equity. So right here we had a title that said assets, right? And then over here we're going to have a title that says liabilities. Now we're just going to list out our liabilities, which are, you know, salaries payable and unearned revenue, right? And then we're going to total those. Okay, here we are listing them here, and then we're going to total them right here. And the total of those two is $12,500, right? Okay, and then we're going to have down here, we're going to have owner's equity. So this is total liabilities. And then down here, we're going to have owner's equity, which we've already decided has common stock and retained earnings. Okay, so common stock is $400,000. Okay, now what is our retained earnings? Look at here. Now, this is a problem. Everybody pay attention to this. What is our retained earnings? Over here, it says our retained earnings is $82,000. Is this our number? No. No, do not fall into this trap. We're not using this number again. We're going to go to this number, right, that we calculated over here, and it's $113,640. So we get the total of this, $513,640, and add it to this number to get $526,140. And double underline that and put a dollar sign.
What's the name? What would you call that number?
This number is total, okay, this one is total owner's equity, and this is total liabilities and owner's equity. Okay? So when we get down to the bottom, if this number does not equal our total assets, what should we do?
If it doesn't,
If it does not equal,
you should look for a mistake.
and how do you find that? What's the easiest way to find that? Subtract them. Subtract. Get the difference in this. Anytime something doesn't equal, like if your totals here don't equal, subtract and see what the difference of it is. It might be a difference of $1,000 or $900 or whatever, and then that's easier to find if you're just looking for, let's see, maybe I didn't carry my 1, or if it's a 9, you might have transposed a number, or you can also, you might have added your debit instead of subtracting your debit, and it might be half of that number is what you're really looking for. Do you know what I mean? If it's $12,000, you might really be looking for $6,000 that you did the wrong way to come up to $12,000. Okay? So those are the tricks of the trade to see where you made your mistake. Okay?